everybody. I am Bonnie LaCourse, Associate Director with Stanton Chase Boston. With me today, I have Michelle Buckley with Boston Common Asset Management. Now, Michelle, I was looking at Boston Common Asset Management, and I know that you guys are a woman-led, employee-owned asset management firm with a focus on the impact and ESG investment space. I was hoping you could tell us a little bit more about the firm and your role within it.
Absolutely. It's wonderful to be here, Bonnie. Thank you so much for having me. Boston Common is an amazing firm in the sense that it is women founded, women led, and majority women owned. And what I am most proud of is that the investment team is majority women as well. As a long-term investor, it's nice to see so many women in the investment space. We have developed as a sustainability leader and ESG integrated investment firm. Our founder, Geeta Iyer, started the firm about 20 years ago with the purpose of being mindful of impact and sustainability. My role within Boston Common, I help run their US large cap core product. I also run the multi-asset solutions business. So we help foundations and endowments and large families with a full asset allocation answer that's ESG integrated from a decision-making perspective. And then lastly, I also support all of our equity products as the global consumer analyst.
And ESG is becoming such an important driver across all industries. I know in the investment space, there's ESG, impact, and socially responsible investing. How do you differentiate between the three?
Yeah, I think it's a really important question, Bonnie, and one that the industry does grapple with of making sure the definitions are consistent. And so far, they're not. ESG, the term is quite amorphous. So I always think it's incumbent upon investors and practitioners to really define what they mean by ESG, SRI, and impact. So in my opinion, SRI, or socially responsible investing, is sort of where this whole area of thought started. And it started around more faith-based investing. And with that, having exclusions around where you could invest. So traditionally sin stocks or energy or defense, things like that were areas where people would not invest in as a result of morals related to religious tenets. But that exclusionary portion, I think, is really akin to the SRI part of this area. ESG, or environmental, social, and governance integration, is really thinking about how companies, regardless of sector or industry, consider environmental, social, and governance criteria within their operating models. And in so doing, are they positioning their company to either take advantage of growth or make sure they're mitigating risk as a result of certain changes in the competitive landscape or certain changes in the regulatory landscape? I try to give simple explanations, of human capital management, how a company treats its employees, the culture of the company. If a company is appropriately paying and offering benefits for their employees, allowing those employees valid avenues for growth, then they're not dealing with really high attrition rates where they have to retrain people, where they have to deal with hiring people or recruiting new people. There's a lot of costs associated with replenishing your labor. So if they have a lower attrition rate, you'll see, again, an improvement to profitability over time. So to me, it's not necessarily exclusionary. It's more about how is a company on a holistic perspective thinking about these areas in their business model. And then lastly, on impact is a trickier one, I think. Some would argue that impact really only works in the private market. So if you wanted to direct specific impact to particular communities or a particular cause, that you could do so in a more effective way by private investment, private equity, private credit. There is another side of that argument that certain public companies are actually trying to develop solutions to areas that need to be addressed. So you think of healthcare companies developing drugs that are helping to solve the obesity issue in the US or globally. That's also a solution, and that's also creating impact. But I would argue that those are two different interpretations of impact. Is it impact from the standpoint of, is my money directly impacting a particular community, or am I assisting a company to develop solutions around impact?
No, and with all that being said, where do you see the growth coming from, and what trends are you seeing specifically?
So there's been a lot of growth in, we'll just call it ESG type funds over the last several decades. This last year, we saw some outflows as a result of sort of change in market dynamics. I think ESG has become a critical component of most conversations for asset managers at this point in time. But the reality is ESG is really reflective of a style of investing. So in my opinion, the early ESG funds really heavily concentrated around technology because technology companies typically had a lower carbon footprint than, say, an oil and gas company, for instance, or a utilities company. With the shift in the market over the last couple of years from more growth-based companies to more value-based companies, it's not that strange to see some of the ESG funds going out of favor because they typically will favor or have historically favored growthier type industries like technology. That being said, Boston Common does offer a value, an ESG integrated US value fund that our founder developed and continues to run. And that has actually done quite well despite not owning energy, which was the best performing sector last year by a landslide.
Greenwashing. I feel as though I'm hearing more and more about greenwashing every day. How often are you personally seeing this happen?
Yeah, greenwashing is a great topic. It's been around since the beginning of time, really in other areas, but the greenwashing aspect is certainly coming under more scrutiny, both from practitioners and from the SEC, from the regulators. Greenwashing can happen when companies see or have, has recently happened when companies are seeing inflows to ESG funds. So they just throw ESG or sustainable or impact in the title of a fund, and suddenly they're getting inflows, even though nothing about that is really supporting any of the ideas of ESG integration. Greenwashing also can happen from a company or corporate perspective. So companies often put out corporate social responsibility reports or discuss their long-term targets for the environment or for supply chain. And sometimes those targets are real and sometimes they're just fluff. And so that's incumbent on a researcher to understand really how truthful and how achievable the targets are.
And let me ask lastly, who is Michelle Buckley outside of the investment world? Let's dive into that.
Who am I? Such a good question. Well, I am the mother of almost 10-year-old who thinks she's probably 30 and I believe will be the next Kendall Jenner. Like she's like very much an influencer, knows all about cosmetics and new hairstyles, and she's really hysterical in that regard. And I do hope she becomes the next Kendall Jenner. Maybe she'll buy me a house someday. So she keeps me quite busy. But besides being a full-time investment professional and a full-time mom, I love running, I love reading, I love traveling when I can. And as we were discussing before we started recording, I love to do last-minute things like go to a Carrie Underwood concert this evening. So that's me in a little bit of a nutshell.
No, I love that. Michelle, thank you so much for taking some time out of your day to share with us about Boston Common Asset Management, ESG funds, Carrie Underwood, of course, but more importantly about you.